Imagine standing on the factory floor of the world's hottest electric vehicle maker. Robotic arms zip around, workers scramble to keep up, and brand new cars roll off the line every few minutes. The company, BYD, is a picture of industrial might. But what if behind this impressive scene lies a massive, invisible debt ticking like a time bomb? What's really going on with BYD's balance sheet? And could the EV champion be masking a financial risk that no one saw coming? BYD, short for Build Your Dreams, began in 1995 as a humble rechargeable battery maker founded by Wang Chuanfu. The company's big break came in 2008 when Warren Buffett's Berkshire Hathaway bought nearly a 10% stake for around $230 million, lending BYD both capital and credibility to enter the auto industry. Early BYD cars were often derided for quality issues, but relentless R&D and government support helped turn the tide. Fast forward to the 2020s, BYD transformed from underdog to juggernaut, riding China's electric vehicle boom to the top of the global industry. By 2023, BYD had surpassed Tesla as the world's largest EV producer, churning out about 3.02 million new energy vehicles, including hybrids that year, dwarfing Tesla's 1.84 million. To put that in perspective, BYD's vehicle output has grown tenfold since 2020, from roughly 400,000 to over 4 million units annually. Now bigger by volume than Ford, Honda, or Nissan, BYD is valued around $100 billion, making it the world's third most valuable automaker after Tesla and Toyota. This meteoric rise has made BYD a national champion in China's push for EV dominance, and a darling of investors mesmerized by its growth. But amid BYD's breakneck expansion, whispers have emerged questioning whether its financial engine is as robust as its production prowess. Are BYD's books truly as clean as they appear? Or is the company turbocharging its growth by piling up hidden obligations? The answer lies in an arcane but crucial aspect of BYD's operations: supply chain financing. In January 2025, Hong Kong-based GMT Research, an accounting watchdog famous for flagging China Evergrande's financial troubles, dropped a bombshell report on BYD's finances. The report claims BYD is essentially addicted to supply chain financing as a way to fund its growth. In simple terms, BYD has been extending its payment terms to suppliers and offloading receivables in order to mask a ballooning debt load. Here's the crux. BYD officially reported a net debt of only 27.7 billion yuan, 3.8 billion as of mid-2024. But after GMT adjusted for the tricks in BYD's working capital, the true net debt shoots up to around 323 billion yuan, 44 billion, more than 10 times higher. This staggering gap arises because BYD has been removing a lot of debt-like obligations from its balance sheet. How? By selling or pledging its accounts receivable, money owed to BYD, and by treating very late payables, money BYD owes suppliers, as if they're just normal working capital instead of debt. Nigel Stevenson, GMT's analyst, didn't mince words. However it's structured, it's clearly a form of financing, hidden debt, he says, accusing BYD of using sleight of hand to present these liabilities as part of working capital. In other words, BYD has been borrowing from its supply chain, but without calling it borrowing. One major tactic is supply chain finance via BYD's in-house platform called Dilink. Normally, auto firms pay suppliers within 45 to 90 days of invoice. BYD, however, has been stretching payment terms to extraordinary lengths, on the order of 8 to 9 months. In fact, data shows that in 2023, BYD took an average of 275 days to pay suppliers. Some estimates earlier in 2023 put it around 257 days. That's 4 to 5 times longer than the global norm of 45 to 60 days, and far longer than even Tesla's typical 90-day cycle. Through the Dilink system, launched 2021, BYD issues suppliers a promissory note or bill instead of cash, essentially an IOU. Suppliers can hold the note until maturity, waiting longer for payment, or cash it early through a bank for a fee. By mid-2023, BYD had reportedly issued a whopping 400 billion yuan, approximately $55 billion, of these notes to suppliers. A clear indication of how heavily the company leans on this practice. From BYD's perspective, this is clever short-term financing. It preserves cash in the near term, since suppliers wait to get paid, and technically keeps debt off BYD's books, because these are categorized under working capital. But the GMT analysis argues that once you recategorize those unpaid invoices as interest-bearing debt, BYD's leverage ratios go through the roof. BYD's net debt-to-equity ratio, for instance, isn't the modest 15% the company touts. It's actually above 200%, over 2 times equity. That kind of gearing is more like a distressed property developer than a healthy automaker. It's no wonder observers are drawing parallels to Evergrande, the Chinese real estate giant whose collapse in 2021 was preceded by years of off-balance sheet debt games. Just as Evergrande used creative financing to hide liabilities until it was too late, BYD's supply chain finance addiction could be building up risk out of sight. What drove BYD to such extreme financing maneuvers? Rapid expansion is a big part of the story. BYD isn't just another car company. It's scaling at a pace the auto industry has rarely seen. In the past few years, BYD has been plowing money into new factories, battery gigafactories, R&D centers, and global sales networks. It launched new sub-brands like Denza, Yangwang, and Fangchengbao simultaneously, rolled out dozens of new models, and entered over 50 countries in a short span. Such breakneck growth demands enormous capital expenditure, CapEx, for machinery, tooling, supply contracts, you name it. Complicating matters, the past 2 years saw a bruising EV price war in China. BYD aggressively slashed prices on models like its Dolphin and Seal EVs to undercut rivals and grab market share, even launching some models at below cost. This strategy succeeded in toppling weaker competitors and boosting BYD's sales, but it also squeezed profit margins across the industry. BYD's own margins are relatively thin, on the order of single-digit percentages, meaning cash from operations alone might not cover its huge growth investments. When you're selling cars cheaply to win volume, you must find cash elsewhere to keep the expansion going, and BYD found it in its working capital. Crucially, BYD's dominance from the price war has given it immense leverage over suppliers. As smaller EV firms folded or scaled back, suppliers became increasingly dependent on big players like BYD for business. BYD could dictate tougher terms, such as pushing payment deadlines further out, and many suppliers had little choice but to accept. Some suppliers even use BYD's promissory notes as collateral to get bank loans, effectively treating BYD's IOUs as good as cash. One could say BYD financed its expansion on the backs of its suppliers, who indirectly lent BYD money by waiting longer to be paid. It's a symbiotic but risky arrangement. BYD gets growth capital, and suppliers stay in the game, hoping to eventually be paid, because BYD guarantees them huge order volumes. The result of this strategy is striking on the balance sheet. BYD's accounts payable and other payables, the line items where these supplier IOUs live, have ballooned dramatically. At the end of 2021, BYD's other payables were about 41.3 billion yuan. By the end of 2023, they had quadrupled to 165 billion yuan. Such a sharp increase signals just how much cash BYD has effectively borrowed from its supply chain to fund its capital needs. For context, BYD's 2023 payables tower over peers like Geely, which had about 87 billion in accounts payable and provides far more detail about what its other payables entail. BYD, on the other hand, hasn't disclosed clear breakdowns, leaving analysts guessing how much of that 165 billion yuan is owed to suppliers via die-link notes or other obligations. In essence, BYD's growth at all costs strategy has been turbocharged by an unusual fuel: other people's money, specifically its suppliers. This has enabled BYD to outinvest and outproduce competitors without constantly tapping debt markets or equity financing. But it raises an uncomfortable question. How long can BYD keep this up? BYD's financing sleight of hand also shines a light on some governance and transparency gaps. It's important to note that none of these practices are outright illegal or in violation of accounting rules. Supply chain financing is common in many industries, and companies around the world factor receivables or extend payables to manage cash flow. However, good corporate governance calls for clarity so investors can gauge risk. On this front, BYD's financial reporting has been, at best, opaque. One red flag is the scant detail BYD provides about its swelling other payables. Normally, investors expect companies to explain what makes up any large liabilities on the balance sheet. BYD's other payables line, which as mentioned, hit $165 billion by end 2023, gets minimal explanation in its reports. This lack of transparency prompted GMT and others to suspect that a big chunk of it is related to supply chain financing obligations. By contrast, a peer like Geely includes specific breakdowns for things like dealer advances, accrued expenses, and financing payables in its filings. The absence of such detail in BYD's case means investors are flying partially blind, unable to easily distinguish normal payables from potentially more problematic IOUs buried in that line. Moreover, BYD has largely declined to comment on these financing practices when pressed by analysts and media. The company's silence, coupled with its rosy portrayal of having a net cash position in earnings reports, has drawn criticism. It almost echoes the "trust us, nothing to see here" attitude that some companies adopted before financial troubles came to light. A comparison to Enron or Luckin Coffee might be extreme, but the principle of opaque disclosures is similar. Investors are essentially asked to trust BYD's narrative, even though the raw numbers hint at a very different reality when adjusted. On the governance front, one could argue BYD's board and auditors should be more proactive in clarifying these off-balance sheet arrangements. The fact that GMT Research, an external firm, had to piece together the true debt picture suggests a shortfall in BYD's own disclosure. It's worth noting that international accounting standards are moving toward greater transparency on this issue. Both US GAAP and IFRS have recently added rules requiring companies to disclose the effects of supplier financing on their liabilities and cash flows. This means global firms are expected to tell investors if they're heavily using payables or supplier finance to fund operations. BYD, listed in Hong Kong and Shenzhen, will likely face pressure to align with these standards, if only to maintain credibility with international investors. In summary, while BYD hasn't broken any rules on paper, its minimal disclosure on a huge pile of quasi-debt raises questions about governance. True transparency would entail BYD explicitly detailing how much financing is hidden in working capital and what the terms are. Until that happens, there's a disconnect between BYD's public financial story and the underlying reality, and that can undermine trust. BYD's situation isn't unfolding in a vacuum. Regulators and industry watchers are paying close attention. China's financial authorities, chastened by past corporate blow-ups, like the Evergrande debacle, have become increasingly wary of hidden leverage in all sectors, including automakers. In fact, Chinese stock exchanges have already taken steps to probe the supply chain finance issue. In 2023, the Shanghai and Beijing exchanges questioned at least 2 of BYD's suppliers about how they account for BYD's die-link promissory notes. For instance, one materials supplier had to explain why its revenue dropped approximately 40% after adjusting for note financing, even as profit rose. The answer was that BYD's solid payment record let the supplier reduce provisions on those notes. Another equipment vendor was asked why it carried no bad debt reserve against BYD's notes. It replied that BYD's notes were AAA rated and posed no credit risk in its view. These exchanges' inquiries signal that regulators are pushing for clarity and prudent accounting down the supply chain, which indirectly pressures BYD to be more transparent with its partners. On a broader scale, the China Securities Regulatory Commission, CSRC, has been working to improve corporate disclosure and rein in financial risks. While there's no specific rule yet capping how long a company can extend payables, Regulatory rhetoric suggests that authorities frown upon practices that excessively delay payments to prop up cash flow, especially if it endangers smaller suppliers or disguises a company's leverage. After all, the Chinese government is walking a fine line. It wants national champions like BYD to thrive globally, but not at the expense of creating a new systemic risk. Beijing has publicly urged companies to self-regulate in the ongoing EV price war and to maintain sustainable business practices. Though that Bloomberg piece was about pricing, the subtext is clear. The government doesn't want a victory in EV market share to turn into a Pyrrhic victory due to financial collapse. Internationally, rating agencies and global investors are also adjusting how they view Chinese automakers. Rating agencies reportedly now factor in the chance of soft defaults, basically companies delaying supplier payments when assessing Chinese EV firms' creditworthiness. This is a telling development. Rather than assuming a company will pay all bills on time or default, analysts recognize a middle ground where firms might stretch payables as an alternative to defaulting on bonds. It's a tacit acknowledgement that supply chain financing has become integral to the Chinese auto sector's modus operandi. If that's the case, regulators might eventually formalize guidelines around it. For example, requiring more disclosures in financial statements, or even setting industry norms for payment periods to prevent extreme cases. It's also worth noting that, in light of high-profile corporate debt scandals, Chinese regulators in recent years have tightened scrutiny on off-balance sheet liabilities. For property developers, they clamped down on shadow banking and hidden guarantees. We could see analogous moves in manufacturing, e.g., requiring large firms to report adjusted debt figures that include supplier financing, or mandating stress tests that assume those payables come due. Any such changes would directly affect BYD's public financial metrics, likely revealing the kind of leverage that GMT pointed out. In turn, that could pressure BYD to either curb its reliance on these tactics or find alternative funding, like raising more equity or bonds, to retire some of the hidden debt. It's important to consider that not everyone sees BYD's supply chain financing as a harbinger of doom. Some analysts point out counterarguments and mitigating factors that could mean BYD's situation, while risky, is far from an Evergrande-style crisis. 1. Hidden debt, but to whom? One counterpoint is that much of BYD's off-book financing is ultimately owed to state-backed banks or stable institutions via those supplier notes, not volatile shadow lenders. Since suppliers often sell BYD's promissory notes to banks for early cash, the banks become the ones waiting on BYD's payment. Chinese banks, especially big ones dealing with BYD, are generally in solid shape or have government backing. This dynamic means the risk is somewhat centralized within entities that the government can control or bail out if needed, unlike Evergrande's convoluted web of retail wealth products that hurt millions of households. So, the argument goes, even if BYD is riding a debt tiger, it's largely a state-managed tiger. The government could direct banks to roll over BYD's obligations indefinitely if necessary, preventing a sudden crunch. Essentially, this view sees BYD's financing scheme as quasi-officially sanctioned leverage, not a Wild West situation. 2. BYD's proactive changes. There are signs BYD isn't blind to these issues. The company has reportedly begun shortening its payable days modestly and being more selective in extending terms to suppliers, perhaps favoring those willing to take notes and paying others more promptly. 3. Industry norms and reforms. Another perspective is that everyone's doing it, to a degree. As we saw, NIO and XPeng also delayed payments. NIO averaged 295 days to pay in 2023, even more than BYD. If long payables are becoming industry standard in China, then BYD isn't uniquely at risk, or so the argument goes. Of course, these counterpoints don't erase the fundamental concerns. They simply suggest that there are buffers and levers that could prevent the worst outcomes. Investors weighing BYD's situation should consider both the bearish scenario, unchecked hidden debt leading to a crunch, and the more optimistic scenario, gradual normalization of finances. Reality will probably land somewhere in between. The truth is likely that BYD will face increasing scrutiny and will have to adapt its strategy, but if done in time, it might emerge with its reputation intact and business model adjusted. As with any fast-growing company, governance evolves. What flies during the hyper-growth startup phase, when everyone is chasing scale, often gets cleaned up as the company matures. BYD may simply be at that crossroads now.